anybody that's young that would be listening, I would want them to enjoy those years because you don't get them back, and they're pretty amazing. But also take a level of interest in learning, because you don't really get that sort of opportunity again, where your whole job is to improve yourself and improve your capacity to learn.
Good morning, good afternoon, and good evening. My name is Drew Pearson. You are listening to the Pearson Perspective. This is a deep dive into the stories and mindsets of successful business operators and investors. Let's go have some fun. All right, today we're going to have a lot of fun. I've got my buddy Doug Stokes on the show today. A mutual friend of ours who's been on the show introduced us, and it's been great getting to know Doug. Doug, thanks for coming on today.
Excited to be here.
Yeah. Doug is in the multifamily family office business, and I'm just going to kind of ask some basic questions about kind of how y'all got in it and what exactly it is you do, because I have kind of a simplified version of what it is, and I'm sure it's mostly wrong. So tell us, how did you get started in the family office and multifamily office business?
It's an interesting story. I think the high level story there is that my dad has been in the wealth management business since the early 80s. He really started out as a typical financial advisor with a partner of his coming out of graduate school. They worked for a bigger shop and then went out on their own in 1987. Essentially what they were doing in the late 80s and early 90s, this was like the big wave of mutual funds coming online. And so they were just out hustling, trying to, earn some sort of sales or commissions to place clients and prospective clients in stock and bond portfolios. In the early to mid 90s, my dad specifically recognized the value of independent and commission-free advice for a fee, with the idea that the incentives were misaligned at the time to be selling financial products to people that are really looking for advice on investment and not necessarily looking to buy something. And so what he did in, I think it was 93 or 94, was transition the firm from a brokerage type arrangement to a fee-based financial advisor, wealth management practice. And that was really early. Now most people do that, but in the early 90s, that was a novel idea. Mm-hmm. He really grew that business pretty substantially until around 2010, in which I was coming out of college and I wanted basically nothing to do with financial services. I thought the stigma around a financial advisor was, I'd heard sort of the negativity around that. And so I wanted to go a different direction. I graduated from TCU in Fort Worth, Texas. And the first thing I did was I hopped on a plane and went to Madrid, Spain, and had an internship with a shipping company over there that I found online. I had no idea what I wanted to do with my life. I thought I wanted to learn Spanish and maybe live abroad for a little while. I did that for about 6 or 7 months and decided that it probably wasn't for me to be a Spaniard. So I came back and I got a job at a software firm in Dallas, and I was there for about a little over a year, and they got acquired. The deal with the acquisition was I could stay on and earn a bonus for sort of a loyalty bonus. It was part of the equity buyout, but if I was there 2 years after the acquisition, I would get a big pop. Or I was talking to my dad at the time. He was saying, "Do you really want to work there for a couple more years? Why don't you just come back to New Orleans and go to grad school, and then when you've got some time, you can come up to the office and learn the business." And so I did that. I decided to jump ship in Dallas and move back to New Orleans. Got my MBA from Tulane and started working in the business, just kind of learning ins and outs. And while I was in graduate school, two things happened. Number one, I took a class on valuation and fell in love with the idea that you could project cash flows into the future for a particular company or a piece of real estate or whatever, discount that back to today and figure out the value that you should be paying for something. And I just like the idea of being able to kind of dig into financials and figure out, if something's a good buy or not. And the second component to that is that I met my wife through a friend in grad school. So my idea of getting away from financial services, and number one, and number two, getting away from New Orleans, sort of backfired on me. I ended up working in the family business and marrying my wife here. We were just a normal wealth management practice, and we can get into what that means. The typical wealth management practice does, up until about 2019, in which what was happening is we're a fully independent firm, and so we were starting to work with wealthier and wealthier families that we'd been around for 30 years at the time, and were becoming known in the New Orleans community. And so the wealthier families we were working with demanded more than just a typical financial advisor service that you would get at a bank or a brokerage firm or something like that. And so we rebranded as a multifamily office, and basically what that entails is more sophisticated investment strategies, more sophisticated tax strategies, estate planning, intergenerational planning, a lot more coaching involved with multi-generational issues, things like that. But I would say the best way to describe a multifamily office is essentially a wealth management firm, sort of on steroids.
Cool. What a cool story. So, some more basic questions for you. When does one need to think about, okay, is this just for guys who have sold their business and they're 60? Do people younger than that need to start thinking about a multi-family office or family office type situation? Who are kind of your ideal clients, I guess is a better way to ask it.
Yeah, I would say if you look at our practice today, we're branded as a multifamily office. I would say about 20% of our client base fits that sort of mold. And essentially what that means is a certain level of net worth, a certain level of liquid assets, or in a position where there's going to be a major liquidity event in the near term. So selling a business, selling a piece of real estate, whatever. And that is that's a substantial net worth. In the I would say eight plus figures is what you would typically see for that sort of structure, the multifamily office structure. The other 80% of our business, we're a registered investment advisor, and we offer wealth management services to what would be considered, it's sort of a cliche now, but high net worth families. And so people that are in regular professions, doctors, attorneys, engineers, small business owners that have accumulated a net worth, that are still working, that are planning for retirement, that are looking for somebody to assist in that sort of pathway. And that's still a bread and butter part of our business. The reason we're structured now from a branding perspective as a multifamily office is just because we've started to get a lot of those relationships in the last 5 years that would demand that level of approach. And really the difference between the two is twofold. Number one, it's investments. What type of investments are in your portfolio between a regular high net worth client and an ultra high net worth client. There's not necessarily a liquidity need on a monthly or annual basis when you've got a mass sum of wealth. You could live off of dividends and interest, and so or distributions from a real estate portfolio. And then on number two, there's not necessarily a need for sophistication necessarily from the perspective of a normal, what's called a W-2 employee that is a doctor at a hospital that earns a high level of annual income, but doesn't necessarily need to seek tax savings opportunities because there's not a whole lot available. And so those are really the two differences is, the sophistication on investments, the sophistication on tax and estate. One type of client requires it, the other doesn't.
Interesting. That's interesting, man. I really got to give it to y'all for. I guess this is part from your dad, and then part from you and your brother of continuing to grow and learn, see what the market needs, and continue to adapt your business. That's really
Yeah,
neat.
yeah. I think where we have a competitive advantage completely is we're not looking to sell anything. So that's, and I've talked to you about this offline before. Our objective is to find the best strategy for any particular client, regardless of not if it's sponsored by XYZ Bank or Wirehouse or Mega Fund. It doesn't matter, or somebody like you, Drew, who we really pride ourselves on that, is like finding people that are under the radar that are doing interesting deals or constructing interesting funds. If you went to one of these big banks and said, "Look, I want to have a real estate portfolio," you would be in one of the top 3 or 4 mega funds. Call it
Right.
you know like Blackstone or whatever. That's where you're going to be. Your portfolio is going to be allocated to real estate in that particular fund. Nothing wrong with that. I think it's fine. Or a fund that is sponsored by that brokerage firm. Nothing wrong with that. Specifically, nothing wrong with that unless the fees are out of control. But what you're going to be getting is in aggregate is sort of nothing special. I'll just say that.
Yeah.
Where we really pride ourselves on is, okay, there is a difference between people that are doing institutional quality work at a sub-institutional level, somebody that has the effect of being able to review an investment, invest like an institution would invest, like a Blackstone or a KKR and Apollo, but in a much more inefficient market where more mom and pops are playing. And if you can find those guys or girls that are operating in inefficient markets but are incredibly talented, then you can really drive returns for your clients. We pride ourselves on being able to find people like you or other people that are trying to affect that sort of strategy in different markets. And that's really where the fun part is for us, is we talk to people all day, every day, that are doing interesting deals, and you can distinguish between what's good and what's bad by having 1,000 different conversations with people that are in self-storage real estate. Well, after every single one of those conversations, who's legit and not, and be able to make informed decisions that way. And I think that that the excitement for us is being able to find those diamonds in the rough for clients where we're operating is not where our competitors are going to operate, because they have product they have to push from higher ups in New York City or LA or Chicago.
I think that's so cool. And I have buddies who work at larger shops, and they just kind of have those off the shelf things they can give to their clients, and nothing wrong with that. But it's so cool to see you guys get in the weeds on all kinds of different deals, looking at value and valuations and character of the sponsor or whoever. It's really cool to see.
Yeah, and yeah, I didn't mention my brother. So I work. My dad's the founder and chairman of the practice, and my brother and I manage the practice. And I've taken the route of more in tune on the investment side, and and I'm a CFA and more you call it classically trained valuation person, and he's a JD, he's an attorney, doesn't practice, but he's taken the planning, tax, and estate planning side and kind of run with that in our practice. So it's a really good complement to have somebody that is looking from an investment side, what's the best investment for a particular client, and somebody from the tax and estate side saying, where should we put this investment in a portfolio to make sure it maximizes its value.
And that's really interesting. I don't know if you can answer this, but y'all both kind of have very pedigreed backgrounds for specifically what you do. Did your dad kind of quietly push you along this route, or did y'all just say, hey, one brother wants to be an attorney, one kind of got an MBA, and it fell this way?
It sort of fell this way. It's funny. Like my dad was my baseball coach growing up, and I hated it. I hated being coached by my dad. Not that he was a bad coach; he was a great. He's a Hall of Famer from Tulane. He held their batting average record up until last year.
That's
For
awesome.
30 something years, he had the record. So he couldn't have asked for a better coach. But I hated, um, that sort of level of involvement. And when I was a kid, and you go to a game, you had a bad game, and you come home, and you can't. There's no separation away from it.
Yeah.
You're always got to. What are we going to do next week to get better? And so, when I got into college and grad school, it was like, oh man, I don't know if I can work with my dad. I just had gone through all this coaching and growing up with him, and we had different personalities, and I had different personality from my brother, and it just sort of just fell that way. I think it ended up where I had a desire to be in this business after sort of getting that itch in grad school. New Orleans is a very small town. There's not a whole lot of finance jobs. If you want to get into wealth management, they're going to give you a phone book and say, call everybody you know and everybody you don't know, and let's see how good you are. And if you can get people to buy products from us, then you can move up the ladder. And I really didn't want to be in that business. I didn't want to be in the business of selling anything other than ourselves. And so this was basically the only place that was doing that at the time that I knew of. Now, there's other people, of course, that are doing it now, but it was just that sort of perfect match in which it was a great firm with a great reputation that was doing the right thing, and it happened to be a family business.
That's beautiful. I've got 4 kids, 2 boys, 2 girls. I would love for all or some of them to follow in the business in some capacity, whether it's a business we have now or maybe it's a future business. What advice would you give to me? You don't want to force it, but it would be really great if it happened. You happen to follow along with your family in the business. Do you have anything that, you'd say, hey, Drew, maybe do this or avoid doing that?
No, there's nothing in particular. I would say like there's always pros and cons to anything. I mean, I've got 3 kids. I would love any one of them to join the business. I think it's very difficult to be in a family business just because there's relationship dynamics that are there already. But it's also easy because you trust the people you're working with to the fullest. Everybody's aligned in the mission to grow the business, to grow the reputation of the business. We're all involved in the community, and so if we're not doing anything right, or somebody at the practice isn't doing anything right, it reflects badly on all of us because we all share the same last name. My dad didn't push it. He said, look, if you want to come back, you can go to grad school. You can, if you need some extra money while you're in grad school, you can come work up here. And then at that point in time, I was trying to do everything not to join the company, and he wasn't trying to force me to do anything. But he would invite me into high-level meetings with people that were powerful people in the city that you would read about in the newspapers. And I was having meetings related to, their finances with them. And it was just really cool to understand and know somebody at that level of intimacy, that you would go home and people say, oh, XYZ, or you work with, this person, or et cetera. And it's just kind of a cool deal to be in a position where, we're looked upon as for advice from people that other people admire.
That is really cool.
And so it was, the way that it worked out was nothing forced. It was just something where I had this desire to join the business because we were doing interesting things. And I'll tell you, one thing I hear about for people is, whether it's follow your passions or things like that, which I think is very difficult to figure out what your passion is going to be. Like, what do you want to be when you grow up? I think once you start doing something, once you feel competent at doing that particular thing, whether it's, managing a self-storage business or managing a wealth management business, as soon as you start getting good at something, then you start getting passionate. And I think that that's, something that I want to instill in my kids. you're not going to know what you want to do when you grow up, but go follow a path. If you like it, great. If you don't like it, move on to the next thing. As soon as you start getting good at something, if people start relying upon you for whether it's advice or decision making or whatever, that's where passion comes in. At least for me, it was.
Absolutely. I mean, that is such wonderful advice. Um, I think that's what I would tell people out of college is don't worry about what you want to do. Go pick a field that you like. And even if you work 2 or 3 different jobs in a field, you're creating a network. You can figure out your niche within that field and really go from there.
Yeah, I think I mean, some people know immediately what they're going to do when they grow up. My wife's a part of a family business too, and they kind of grew up in that business, and everybody, her and her 2 brothers are all involved there, and they've kind of picked their field within the business. But yeah, it's a very difficult. It was difficult for me, which is why I essentially went to Europe for 6 months after college because I had no idea what I wanted to do. But I think it's, if you pick something, just pick it, and then if you find out you're good at it, then you'll become passionate.
I think that's great advice. You just had a recent guest on your show, Jason Baker. I thought that was really a great episode. And if I remember correctly, it had more to do with transitioning all the family assets, not just financial assets, but really those relationships and core values, the mission and vision of the family. Um, do y'all kind of work within that field with families also, and how do you kind of think about that as you're coaching and counseling families?
Yeah, it's really difficult, and Jason was a fantastic guest. And for those that haven't listened, essentially, he played in the NFL. He was a punter for the Carolina Panthers for 12. I think it was 12 years. Maybe 8 of that was Carolina, and he bounced around a couple other places. And then he bought a business called Pearson Center, and essentially what they do is they go around to different families. They get paid a lot of money to do so, and figure out where particular family members' roles will be within the family from a relational perspective, and then within the family business, financially, philanthropically, et cetera. And dealing with a lot of families like we do, we rely on people like Jason or their tax advisor or their legal advisor to really set up a core foundation for that family to be able to make decisions. I think the best way, so yeah, the answer is we work with families in that capacity on the financial side, and we help quarterback some of those meetings. But it's so difficult when you have somebody that wants to be very involved on one side of the spectrum. A family member, second or third generation, wants to be very involved in either the family business or the investment side or the philanthropic side. On the other side, you have family members that have nothing, that they don't want anything to do with the family business or investments or charity. And so bringing all of that together is a very difficult task. And I think what people like Jason do is exactly right. You create a mission for that particular family. You create values for that particular family. You write a constitution and say, this is what we're all about. And this is how we're going to run this particular family, just like you run a business.
Mm-hmm.
And then work within the confines there. And then if there's issues, which there's bound to be, especially when wealth is involved, then you refer back to those sorts of agreements that you've made and your role within the family. And so I think, it's difficult. We had a meeting this morning with a family like that, where it's just a lot of different personalities in the room, and then when there's money involved, it can get pretty ugly sometimes.
I can't imagine. The 2 things that stuck out where I just love that idea of a constitution. I guess people have to buy in to the Constitution. You can't just slap it down on the table and say, this is the law. But it also kind of creates a decision-making framework for how do we get through conflict resolution is essentially what we're trying to solve for here.
Yeah, roles in conflict resolution. And I think one thing about constitutions is they work if you follow them. Like if you look at South America, I think Argentina specifically has a constitution. I think they have like 1,000 or so amendments to it. And so Yeah,
Yeah.
constitutions work if you make it very difficult to change. You get original buy-in from all the members involved, and then refer back to that when you have issues. I think that that's a very powerful way to conduct intergenerational family planning. And things get really difficult when kids and grandkids are involved. And as further away you get from the people that actually made the money, the more difficult it gets to preserve. And there's always those stories about basically by the third generation, wealth has been exhausted. And so really part of our job is to make sure that doesn't happen. I mean, we can control as much as we can control, but you need to bring other people in to help facilitate those discussions between family
Yeah.
members.
Are you familiar with Mike Boyd? He's from Australia.
No.
He's done a lot of really great work in this space. I've got to know him from Twitter, but he's kind of got this concept of going from a family business to a business family, which I think is really neat. And it essentially requires that second and third generation to kind of top the pot off, whether that's a new business or something. You got to contribute to the legacy here and not just live off distributions and think this is the way it always has been.
Yeah, I completely agree. I think the communication that we have with people is, maybe your business that made you money doesn't exist anymore because you've sold it and you had a big liquidity event or whatever it is. But the result of that, the liquidity that you've received from that, is just like starting a new business. You got to allocate capital correctly.
Mm-hmm.
You've got to put people in particular roles and make sure that they're adhering to their responsibility within the family and that particular business. You've got to hold people accountable. You got to come down on people when they're not doing, things the right way.
Yeah.
You got to control spending. And so, if you can, those are very difficult decisions to make. And when family's involved, even more difficult. Now we are a family and we're in a family business, so we deal with those decisions internally every day. But some people that are not used to it, it's or that don't want to be involved, or maybe have drug problems or whatever it is.
Right.
It's hard. And so I think part of the service that's provided is facilitating those discussions and bringing the right people in to help make those decisions within the family. So somebody like Jason is perfect example of, hey, maybe we got to bring somebody in that can help structure this, that help us draft that constitution, help figure out what everybody's needs and wants are, and make sure that the family's aligned in its values, and then control it from there. Have regular discussions, whether it's quarterly or semi-annually or annually, to make sure the family's on the same page. From an investment perspective, are we putting money where that aligns with our values? Whether some people want to only invest in certain areas of certain markets because it aligns with their philosophical beliefs, or contribute to charities that align with their beliefs. And so those are all complex things that wealthy families have to deal with. They're not all bad problems to have. There's a substantial sum of money that you're a beneficiary of, but being responsible about it is very difficult.
Yeah, no, absolutely.
I'll tell you my favorite thing though, to do is, and I deal more on the investment side, but like meeting people like you is really it's the best part of the job. Is basically every family has its issues, right? But one of the things that makes me happy is basically saying, look, what we can do is put together a portfolio that's different than you'll find anywhere else. Hopefully that's a positive, and we're willing to take the risk that it is a positive. And then we have this large sum of capital across multiple different families that we're responsible for. We have to go out and find a place to put it. And so, basically 75% of my job is talking to people and figuring out where to place capital. And you get to meet interesting people by doing so, and people that you admire. Like you'll read somebody that's been writing, let's call it on Twitter, for 10 years, and you've been reading their research for a decade, and then all of a sudden you get connected with them, and you're you're talking, hey, how do we place X amount of capital, and they're providing advice, or they've got a fund that they're raising or whatever it is. And so the network effect of being involved in financial services and doing things the right way, and finding people like you or other people through, I'm involved in financial Twitter as a lurker, and I read everybody's posts, and I don't get actively involved, but people that you admire that will connect you with other admirable people, all with the objective of making other people money, is really fun.
It's really fun. I couldn't agree more with you. I feel like our generation is just starting to get kind of a real toehold on our career, and it's exciting to see where the next decade or two is going to go.
Yeah. This is an interesting time too to be placing capital. I want to maybe I'll shift to interviewer here. I just got a note from somebody that just closed on a refinance. They got it done, I think, in August or July or August, and when the rates came down a little bit. But now it seems like everything's tightening up. And anybody that holds any asset, there's two paths forward. Number one, either you're over levered, you got to find a way out. You feel like there's a window that you got to sell, and you're gonna try to liquidate at some point in the near future. Number two, you've got a major differential between what you expect to receive because you're kind of anchored to 2021 prices and what the market's willing to pay. Or number three, you just hold and just keep clipping coupons and just wait for the cycle to rebound. What are you seeing? You're on the ground daily in your area, whether it's Class B industrial or self storage. What's going on in your world?
Yeah, it's definitely an interesting time. We were doing deals at 3.5% in December for interest for our interest rate. We're about to close on a property next month, and I'm going to be between 6.5 and 7. So it's almost doubled in 11 months. It's going to be a conversion project.
What cap rate are you buying? Go ahead.
It's a conversion project, so it's a vacant deal. Okay. So we need about 50 or 60% occupancy to break even. So I think the project's going to be fine. But the opportunity to buy existing businesses or, God forbid, a Walgreens triple net deal have virtually evaporated. I'm having a guest on the show in a couple of weeks they own a lot of they're one of the largest single tenant owners in the country. And so I'll be real interested to see what he has to say about how interest rates have affected their business.
Single tenant net lease.
Yeah. Dollar Generals, AutoZones, all that stuff.
But yeah. I mean, it's difficult. If you're borrowing at 7, I mean, you gotta buy at 8 at least to make money. Yeah.
Yeah. I think the people who are going to be in the most trouble are just they call them the IRR guys. Like we get 20% IRR, and we were expecting to refi at a 4% interest rate in 5 years or 2.5 years, and that's gone now.
Yeah.
So will they be forced sellers? Can they hang on and pay down more debt and see what happens? I don't know. I do know most of the bank.
Yeah, most of the
banks I talk to, they require 25 to 35% down. So that's a pretty good equity in the deals.
Yeah, I mean, I think, look, if you've got a big enough equity cushion and you're conservative about leverage, you're probably fine. But I can't stand those pro formas that you see where we're buying at a 7 and we're selling at a 5 or recapping at a 5 in a few years, and that's where the return comes from. That's just I think that's a disingenuous way and a overly bullish way of presenting a deal. Look, either exit at what you bought for, and what does the deal look like at that point, or maybe cap rates expand in your world, and what does the deal look like at that level? Otherwise, it's like, look, I don't want to see your best deal. I want to see the worst case, or at least a bad case scenario, and if everything's above that, then it's laying you out.
Right. We need a healthy margin of safety. And we just saw so much of that. I mean, everything that had income sold, and there was a lot of times I said, golly, did I miss opportunities there? And I'm sure I did, but it's been bananas the last couple of years. And honestly, it feels good to kind of come back to earth a little bit, add a little more sound underwriting, and just take a breath and say, listen, trees don't grow to the sky here, people. Stuff happens.
Yeah, I think it's. I think in your world, and I think it's. I honestly am very excited about what's going to be happening in real estate in the next couple of years because it's almost like it's difficult to pull the trigger on anything, or it has been in the last really since early 2021, maybe late 2020. And now if you've got cash, now of course in my world, one of the biggest mistakes you can make is just sitting on cash and waiting for opportunity and basically climbing that wall of worry where market prices continue to go up but you believe that you're going to catch the next drop. And so, I'm not going to deploy cash because I'm waiting for the next downturn. Well, guess what? That next downturn's not coming. And so
Right.
you're sitting on cash forever. And so I'm comfortable putting capital to work. I just don't want to see a situation, at least from a presentation perspective, from a manager or a sponsor that assumes good things are going to happen. Let's assume bad things are going to happen. If I can still make money, great. And then if good things end up happening and we make more money, then all the better. I also like the idea of you mentioned a conversion project, and I guess we can just start talking real estate. I think the only real way to make money in markets right now, from a when either values are high or debt is expensive, is either value add, conversion, buying something that's 50% leased and getting it to 80 or 90. Otherwise, like if you're triple net Walgreens, and if you're borrowing at 7 and you're buying a 5 cap, you got some problems.
Yeah, it's never going to work.
Yeah.
And I love how you can just kind of see that so clearly. It's like, well, we can either buy to 5 cap, do nothing, value add, or development. And if you want to make money, the last two are your only options. And certainly value add de-risks your investment. The walls are there. There's no permitting and zoning. You're in a better position for success, which is kind of all we can ask for. And eventually we're going to do a bad deal, but we just want to over time be in a good position, to win.
Yeah, and I think the other thing too is when you're doing this yourself, and we have the same mindset that you essentially everything you have is essentially your reputation. If your reputation is tarnished in any way, then especially when your name's on the door, it's just very difficult to recover from that. And so the mindset that you have to have is, okay, the deal has to work. Now, not every deal is going to work, but the mindset has to be, I'm going to look under every stone to make sure that this is, I haven't missed anything here, and then pull the trigger. Because if it goes south and people start, this is not a big city, so people start talking about a deal that went negative or whatever, then it's just very difficult to recover from that. It's difficult to get new clients. It's difficult to keep clients, and so it has to be now if you're a big wirehouse and a deal goes south, well, it doesn't matter. You've got the brand name behind you, but when your name is the brand, you just can't screw up. And it doesn't mean you're not going to. It just means you have to have that level of care.
And so what we're essentially talking about here is trust. It's funny you bring this up. This is like my next newsletter coming out is about building trust. How do you guys think about that? Do you think about that? Is it reporting? Is it simply just doing what you say you're going to do over 30 years? I don't know.
Yeah, I think there's some institutional trust in there because the business has been around so long. We've also got a great network of other trusted advisors that we work with. So if you work with a CPA that's sort of in our network or an attorney that's in our network, and they recommend you work with us, and that's a big, a big boost to the trustworthiness of our firm. But I think you already said it. It's just either under promise, over deliver, or just do what you're going to say you're going to do, and don't be full of bull, basically. And I think that that's part of the problem in this particular business is there's always an excuse. We didn't do this because, or we underperformed because. Look, if you didn't do a good job or you underperform or whatever, just say it and just be honest with the person you're working with. You're doing your best work. Some years are going to be good, others years are going to be not so good, but you're gaining that level of, hey, these guys are not bullshitting me. They're being honest, and that's really what people care about more than anything. Is number one, you designed a portfolio or you designed a strategy that was in my best interest, that I signed off on after we discussed it. Things didn't go our way. That's okay, but things don't always work. But you didn't try to go around us or feed me some sort of garbage or an excuse as to why things didn't work out.
Mm-hmm.
And I think that builds trust over time.
Yeah, I agree. I want to ask you one question, kind of selfishly, then we can kind of bring it home. You talked about institutional sub-institutional folks acting on an institutional level early in our conversation. A big part of what we're trying to do is really level up our game and reporting. How do I or other small operators um, improve how we present an opportunity or become more professional or institutionalized in your mind?
I think there's two components to that. Number one, it's the level of diligence. So when an opportunity is brought to the table, it's, this is the deal. This is the former owner. This is why they're selling. This is line item by line item, every single expense that we can see for this particular, let's call it a real estate project. We just did one that was a hospitality project outside of New York City with a group that has that sort of profile. Guys that worked at major institutions that went off on their own to try to do something at a sub-institutional level. They've thought about every single line item expense. They've looked at the market. They've looked at their comp set of 15 different projects in their particular region. In this case, it's a hotel, so it's occupancy and average daily rate for the hotel versus their competition and why they're going to be, increasing either occupancy or rate. What are the levers that we can pull in this deal? What's the market from, an exit perspective on a cap rate? And let's sort of assume that we don't hit our numbers, and what does the deal look like then? But ultimately it comes down to, from a presentation perspective, as I'm asking questions, the presentation already has the answers. There's been such level of diligence done. It doesn't have to look pretty. I think that's a misconception. It's like these mega shops have these huge marketing departments that make every deal look attractive. Just have all the diligence done where I feel like you haven't missed something. You've already answered the questions before I've asked them. And then it's just knowing the people. I think it's, once you have, dinner with them, you have coffee with them, you've talked to their friends, you talk to their family, their friends and family are in the particular deal that you're looking at too. They're mm-hmm. confident enough to put their own money and their family's money into the deal. Those are all the things that are just, box checkers. A lot of times when you're doing a big deal with a big shop, the sponsors, there's sort of two layers of sponsors. There's the people that are actually putting the deal together that don't have their own money in it. And then there's a second layer of people that are just collecting a commission for you committing to that particular product or deal. And it's just hard to get comfortable with those sorts of things. If you're not confident enough to put your own money in it, then why are you selling it to me? Right. Why am I so lucky? And so that's those are simple things for us that, either it's a reputational thing where you've done prior deals at bigger firms and you're taking that sort of institutional knowledge downstream, or there's maybe you're a first timer, or maybe you've done it for yourself but are sort of branching out to syndicate something, and you've done so much homework on this thing that it makes me confident that If it doesn't work, it's fine, but you've basically uncovered every stone in advance of that. So I don't think there's anything in particular. It's just you got to skin in the game, good reputation, and then the level of diligence.
That all makes sense. That makes a lot of sense. All right, Doug. Well, this has been a ton of fun. I've got two kind of wrap up questions. The first is, do you have any books that you recommend that you've gifted, or books that you've read personally that have really kind of impacted how you think?
That's a really good question. I'm not reading a whole lot of books these days because I just had my third child. So I'm reading Dan Crenshaw's book right now. It's called Fortitude. It's very good. I'm about halfway through it. And the last book I read, that was this doesn't impact the way I think. I just think it's a damn good book. Is now I'm missing the name of it, but it was Eric Larson's book on Winston Churchill and the decision making that he was going through during World War II.
Okay.
But yeah, so I'd say I'm about halfway through Crenshaw's book right now, and I admire him as a person. I don't agree with everything he does politically, but I sort of go towards those Navy SEAL type guys and military history and biographies is where I play. But
cool.
I think he's got some good stuff.
Cool. I like it. All right. So last question I'd like to ask guests. If you could give yourself advice 10 or 15 years ago, what do you think you'd say?
That's a really good question. I think one of the things that I wish I would have done a better job of is, I treated college like most college kids. So I graduated college 13 years ago. And so as I was entering college, I really had only one thing in mind, and that was enjoying college and not really enjoying the learning atmosphere as much. And so I really regret that. I try to learn as much as I can now, and I wish I would have had that level of attention in college that I've sort of evolved to have over the last 15 years. So one thing anybody that's young that would be listening, I would want them to enjoy those years because you don't get them back, and they're pretty amazing. But also take a level of interest in learning because you don't really get that sort of opportunity again, where your whole job is to improve yourself and improve your capacity to learn. And so that's one where I would have spent a lot more time if I was a little bit wiser.
That's great advice. I would probably ditto that.
Although it's pretty fun when you're there.
Yeah.
Yeah, exactly.
Well, Doug,
the other thing I'll tell you this too, and we got to wrap up, but I'll also say this. I think your reputation, I've said this on this podcast, but I think your reputation is so important, and to always keep that in mind. And I say that because the people that I've worked with over the last 13 years or so that have helped me get to this particular level are relationships that I've developed throughout my whole life, whether it's growing up as a kid or going to college in Fort Worth or living in Dallas or coming back here and going to grad school and then meeting my wife and all her friends and family. And it's people want to do business with people that they like and that they trust.
Yep.
And so you could have faults, but if you're somebody that is focused on at least being a good person and doing things the right way and being honest and being trustworthy, then that's 95% of it. And so, that's something that if you're a young person, make sure that you're really caring for and looking after, how people perceive you.
Yeah. Those are two dynamite take homes.
Yeah. Well, thank you, Drew. This is awesome.
Doug, thanks so much.
We have our own podcast, but this is it's way better being a guest than the host for sure.
Yeah. Well, man, I'm so glad you came on. I've got some other buddies I'd love to introduce you to. And this has just been a ton of fun.
Thank you, Drew.
All right. See you, buddy. I would really appreciate it if you'd leave us a review on Spotify, Apple, or anywhere you're listening or watching to this show. Thanks so much for joining us on this audio adventure. Let's go have some fun.